Assalamualaikum warahmatullahi wabarakatuh. Today our group will present on the consequences of equity fund flow on Asian exchange rate with a focus on Vietnam and Malaysia. We will explore how investment movement impact currency strength, economic stability, and policy response in the region. So next, let me explain what is equity fund flow. Equity fund flow refers to the movement of investment capital into and out of a country, stock market. When foreign investors buy local stock, they convert their currency, strengthening the local currency, and when they withdraw, local currency returns. This is especially important in Asia, where increased openness to global investment means this flow can directly affect exchange rate stability, inflation, and trade competitiveness. Vietnam, as a fast-growing economy, has been rising foreign equity investment, which influence the strength of its currency and export performance. By examining Vietnam, we can better understand broader financial dynamics in Asia and the need for effective policy responses. Our economic review covers 5 main areas. First, growth of income, balance of payment, stock market, political or policy changes, interest or inflation rate. So, each of the factors play a role in how equity fund flow impact exchange rates and overall stability in Vietnam and Malaysia. First, let's look at the recent economic growth trends. For Malaysia, in 2022 saw a strong rebound with 8.7% GDP growth, driven by border reopening and export. Growth slowed in 2023 but rebounded in 2024 due to FDI in renewables and digital sectors. While Vietnam also experienced high growth, which is 8% in 2022, slowing in 2023 but accelerating again in 2024 with a strong FDI in high tech and infrastructure. By 2025, both countries showed resilience, with Vietnam maintaining solid fundamental and investment appeal. So next, in terms of balance of payment, Vietnam maintained a strong external position with a current account surplus driven by robust trade and rising remittances despite some capital outflow in 2024. Malaysia also had a current account surplus mainly from goods export but experienced dips due to primary income deficits and weaker exports. However, it rebounded in late 2024 and early 2025. So both countries show resilience, but Malaysia financial account face persistence of low highlighting vulnerability to global financial volatility. Besides, in terms of inflation rate and monetary policy factor, Vietnam inflation peaked in 2024, triggering tighter monetary policy which then stabilized inflation by early 2025. While Malaysia managed to keep inflation low, supported by subsidies and stable interest rate, the difference lies in how countries respond. Vietnam react more aggressively to inflation, while Malaysia relies on subsidies and rate stability. Additionally, in terms of political landscape, which is foreign ownership policies, Vietnam has more restrictions on foreign ownership, limit on property and company share, while Malaysia is more open. This openness makes Malaysia more attractive but also more exposed to capital flight during crises. Next, let's continue for stock market trends. Investor sentiment greatly impact equity flow. Both countries saw stock market gains in 2022, decline in 2023, and partially recovered in 2024. By 2025, global uncertainty created volatility. This flow strongly influenced currency strength in both countries. So next, let's analyze of equity fund flow impact. In terms of concept of equity fund flow and exchange rates, trend analysis of equity fund flows and exchange rates, interest or inflation rates, and political or policy changes, and the last one is stock markets. Next is concept of equity fund flow. Equity fund flow are influenced by interest rate, investor sentiment, political stability, and overall economic performance. When foreign investors pour money into the stock market, it increases demand for the local currency, causing their appreciations. But when they pull out, the currency weakens. This movement is a key driver behind the fluctuation in the Malaysia ringgit and Vietnam's dongs. This table shows finding and analysis of equity fund flow impact from 2005 to 2025. Malaysia's currency was affected by political issues and market fears, causing capital outflow and volatility. In contrast, Vietnam had strong FDI and consistent governance policies. Even during COVID-19, investor confidence stayed strong. So we can see Malaysia is more reactive to global sentiment, while Vietnam's controlled approach brings more stability. Next, this table shows 20 years exchange rate trend for Malaysia and Vietnam. From 2005 to 2008, real precious growth, which is Malaysia ringgit stable, while Vietnam dongs begins controlled decline. In 2009 to 2013, post-crisis adjustment, which is Malaysia's stimulus versus Vietnam's FDI focus. While in 2014 to 2019, geopolitical disruption, which is 1 MDB and oil prices. And the last one, in 2020 to 2025, pandemic and recovery strategies. So, in addition, this slide also shows finding and analysis of equity fund flow impact from 2005 to 2025. Next, I will explain about Malaysia, FDI, and exchange rates. Malaysia's openness to foreign capital made it more vulnerable to global shocks. Events like 1 MDB scandal and oil prices drop lead to the capital outflow and exchange rate pressure. Even as investment pick up in a green digital sector, the ringgit continue weaken. Let's talk about Vietnam FDI and exchange rates. Vietnam shows stronger management of capital flow thanks to the strategy FDI and high-tech and strict policies by SBV. The dollar's depreciations were gradual and controlled. Even during COVID-19, investor confidence remained high due to consistent policies. Then let's compare both countries, Malaysia and Vietnam. So when comparing both countries, we can see that Vietnam stand out for the cautious and consistent policy, while Malaysia open model make it more dynamic but also more volatile. The managed flow in Malaysia versus Vietnam control exchange rate show differing, resilient to shocks. Then this slide show comparison of Malaysia and Vietnam in three main areas, which is exchange rate policy. Malaysia use a prudent system that react to the global event, while Vietnam control its exchange rate more tightly to avoid big changes. Then, in terms of equity flow sensitivity, Malaysia open market means money come in fast but also leave fast during crisis. Vietnam strictly rules make fund flow more stable. Next, in terms of foreign ownership, Malaysia allow foreigners to own property and business more freely, while Vietnam limit foreign ownership, especially in real estate and certain sectors. So next, let's continue for stock market trend 2022-2025. Both countries saw market rise in 2022, fall in 2023, and recover in 2024. Vietnam's recovery was helped by strong governance policy. In terms of inflation and interest rate, Malaysia kept inflation low and interest rate steady. Vietnam had higher inflation but managed to bring down with a tighter policies. Next, balance of payment. Vietnam had strong export and FDI, keeping the economy stable. Malaysia also had trade surplus but faced more outflow due to investor cautions. Overall, Vietnam is more stable and controlled, while Malaysia is open but more affected by global risks. So in conclusion, equity fund flow significantly influenced the exchange rate stability in both Malaysia and Vietnam. Malaysia's openness to foreign investment creates opportunities but also exposed to the ringgit to the higher volatility, while Vietnam cautions and control strategy help it maintain economic and currency stability even during global shocks. This comparison shows the importance of balancing openness with regulation to maintain long-term stability in Asian economies.